One of the most clear signs about how an economy is proactive and healthy is the fact that what is the ease of doing business in there. When we are talking about ease of doing business, India has been putting up efforts in this very direction for a very long time. And yet another step has been taken in the name of Corporate Law Amendment Bill of 2026. But this is not straight up. There is opposition and there is a lot of criticism. But the question is why? Hello everyone, welcome to Vajiram and Ravi /news. My name is Shubhangi Singh and today we are going to understand that what the Corporate Law Amendment Bill of 2026 proposes, what are the key provisions, what are the key issues and what is the way forward from here. So let us begin from the very scratch of the fact that what exactly is unfolding. So the Corporate Law Amendment Bill of 2026 has been tabled in Lok Sabha by our Finance Minister, and as of now this has been referred to Joint Parliamentary Committee, and this Joint Parliamentary Committee will be submitting their report in the monsoon session. When we are talking about Joint Parliamentary Committee, understand this as a committee where it has members from both of the houses. In total, the membership is 31 members and they are the ones which suggest changes, which look into the details of very important key bills. When we are talking about Joint Parliamentary Committee, as I mentioned, they have 3 members, 21 members coming from Lok Sabha and 10 members coming from Rajya Sabha. Now going back to the Corporate Laws Amendment Bill of 2026, what is it here for? It is here to amend 2 important existing acts. First, Companies Act of 2013 and second, Limited Liability Partnership Act of 2008. Now this clearly shows that it has a lot of importance because it has been referred to JPC and the report would be given, and it also shows the fact that it also has certain concerns around it. So let us try to decode all of it from here. So once we are talking about this bill, let us start with understanding the objectives. The first and the primary objective of this particular bill is to ensure ease of doing business. How it is going to ensure that? First, it is going to reduce compliance burden. That means there will be less paperwork. Second, it will also simplify regulations which are present. This bill also has a very clear objective to decriminalize. That means make minor offences civil. Before that, they were criminal offences. So the focus would be on making them civil. That means fines would have to be paid instead of jail time. And a bigger idea here is also to bring in modernization. That means alignment with the global best practices, focusing on bringing international level norms so the standards of corporate match around. And this all is driven by the idea of governance reforms itself. That means there will be strengthening of regulators such as NFRA, that is National Financial Regulatory Authority, through this very act. There will be strengthening of regional directors through this very act. So a lot of structuring is going to be done and we will be able to understand this better once we look at the key provisions. So as I said, the objective is to decriminalize. So offences will be decriminalized. That means it will help in reducing litigation and the business sentiment will also improve. One of the biggest changes that is being announced and that is being questioned is the corporate social responsibility changes. Before we understand that, let us talk about what exactly is CSR. Corporate social responsibility. That means corporates are making money. If you are making money, then you have some social responsibility to contribute. So in this context, corporates which are making profits more than 5 crores, they have to contribute 2% of their net profit, so as to ensure that they are doing something socially responsible. That is corporate social responsibility. Now the CSR threshold is being changed from rupees 5 crores to rupees 10 crores. That means the corporates which are earning 10 crore worth of profit, they will be asked to contribute this way. Now this way small companies will get exempted from this, and if there is unspent CSR money with the company, that transfer time has been changed from 30 to 90 days. This has been ensured. So the major change has happened around corporate social responsibility itself. When we are talking about other key provisions, we also get to see that corporate governance reforms have been brought in and they have been addressed through reduced compliance of small firms. That means the auditor appointment that was required, the filing fees that was required, that has been relaxed. That means especially for smaller firms, the compliance burden has reduced and that will enhance and help not just their productivity but the liquid at hand as well. Apart from that, because post-pandemic we are seeing a clear digital shift, digital governance has also been mentioned in the provisions, which talks about that if AGMs and EGMs are taking place, they can happen via video conferencing. However, one physical AGM, annual general meeting, will be conducted every 3 years. That has been made mandatory. Before this, the provision of video conferencing was not present. Another key provision that has been introduced is about capital structure flexibility. So once we are talking about capital structure flexibility, let us understand capital structure first. So when we are talking about capital structure, it basically means that how the company is arranging their capital. So company raises their money through loans, that is debt, and company raises its money through shares, that is by giving their equity. So how company is going to structure their capital? In those norms, flexibility has been brought in. That means if the company wants to increase the prices of their share, or if they have excess cash and they want to return it to their shareholders, that means they're buying their shares, that is a share buyback. Companies buys its own share, that means they will get the equity back with themselves. That means for that, easier norms have been introduced. But at the same time, the proper oversight, the regulatory oversight has been retained. Companies should have flexibility to move their capital, but the protection to the investors has also been ensured. Now, another provision that has been brought in is for trusts. Trusts which are operated by investors, especially as investment vehicles, they have very limited flexibility. So for them, there is a provision to convert to limited liable partnership. They can continue their operations just like they were doing. Only the trust needs to be registered with either SEBI or IFSC prior, and then they can ensure their LLP conversion. So becoming a limited liable partnership gives them liability protection also and gives them a lot of flexibility in terms of operations. Now coming to the last provision about more power that has been given to NFRA and also regional directors. So when we are talking about NFRA, what has been done here, that enhanced rule making power has been given to them. The technical term that we use is delegated legislation. Now NFRA as an authority can make rules about how audit standards will be set, compliance requirements will be made, and they also have the power to classify companies. So classification would also be done right here. Furthermore, NFRA has been given the power of adjudication. That means decision making if any scenario happens, if any violation happens, and also penalty framework would be decided by them. And this has been done that okay, regulatory oversight will be maintained by the government, but all these powers have been designated to them. Now when we are talking about regional directors are senior officers which are present in MCA. Now what has happened that they are also getting expansion of adjudication power. Furthermore, we are getting to see shift from criminal courts to administrative mechanisms under them. This has been done to ensure faster dispute resolution. This has been done to make sure that there is reduced discretion, because all of this would be rules based, the penalties, but at the same time this leaves a lot of scope for corruption. And that is why concerns are heightening here. When we look at these key provisions, we are talking about amendment of Companies Act. For example, if we are looking at digital governance, if we are talking about corporate governance reforms. So these are applicable to both Companies Act and LLP Act, but this is applicable to only LLP. Other provisions which we were talking about, for example, decriminalisation, again applicable to both, but CSR only to Companies Act, the relaxations only to the Companies Act. So these provisions have been put up in the bill, and that is where our concerns are also arising, that there is a lot of rule making power that has been given to NFRA and a lot of power has been given to RDs. That means the role of legislature, law making might reduce because of this excessive delegation. Furthermore, when we are talking about CSR relaxation, it also shows that it is diluting. If you have increased the threshold, lesser companies would come under CSR, and that will reduce the impact as well. And most importantly, in this scenario, we are seeing that decriminalization might become an incentive for the people that, okay, nothing will happen, we only have to pay money. So that will create a lot of weak deterrence in this scenario. So these are the concerns that have been put forth. What are your thoughts on this? Let me know in the comment section, because this is not the first time that the corporate law is being amended, but at the same time, these amendments are very important to the future of our economy. So they need to be put in the right direction, otherwise the consequences can be fatal. So let me know in the comment section. I'll be leaving you here with a prelims practice question. You can put down your answers in the comment section. That was all from my side. Thank you so much.